Sammy Trades NQ back with another video. Today I got an options video today. All right. And today is a very important topic because what happens if the trade goes against you? This is the main question I always get. And if you don't know the answer to this question, you shouldn't be trading options at all. If you don't know what you're just in general, if you're trading in general and you don't know you don't know what to do in your worst case scenario, then you're really not really protecting yourself, because as a trader, what are we? We are risk managers. We are preservation of our capital. That is our major thing, is to preserve our capital. That's our main job, is to preserve our capital. We can't. The first rule that we learn about trading is don't lose money. The second rule is don't lose money, and the third rule is don't lose money, guys. That's it. The rules in trading is that it's it. You don't lose money. And I'll explain to you how to lose less money when things go against you. All right. If you're new here, I sell options for consistent income. I'm not gambling. I'm not guessing directions. And today I want to break down exactly what happens when a trade does not go your way. Just calmly, step by step, and think. First thing to understand, when you sell an option, nothing explodes immediately when price moves against you. So what ends up happening is, let's say you put some puts on SoFi, right? Next thing you know, SoFi does earnings coming soon, and they shoot to you in these particular times. So let's say if you picked a 30% delta, $23.50 is your strike price. Let's say SoFi, God forbid, SoFi gets a crazy earnings and it shoots down, right? It shoots down and goes all the way to like $20, right? What do I do? I just put these puts. What is my base case scenario, right? And that's what we got to do. So when you're selling options, you got to understand to be calm, collective, and just in general, you got to be calm and collective when you're trading, especially when you're doing options long term out. You got a lot of time to do this, but again, you need to use this time efficiently. You can't be too patient, and then you weren't fast enough to roll. Then you got stuck at getting these shares at a higher price than what it's actually going for. So here I'm going to talk about, first let's talk about cash secure puts. What happens when it goes against you? So my example was SoFi's earnings are happening pretty soon. I think they're happening next week. And let's say it goes from let's say I have a strike price of $23.50, and let's say it's going against me, right? The stock is going down. My goal is, when I'm selling these cash secure puts, if I truly believe, and this is where you got to use some technical analysis to hopefully, and as well as some fundamental analysis of the company. And do you think, is this a nothing burger, or is this like a something? Did like anything change? Did management change? Did motive change? Did sentiment change for the stock? See what changed in these particular times for earnings, and just in general, big news, big deals and stuff like that. You got to understand what changed in your stock, because at the end of the day, if you have high conviction of the stock, if you sell a cash secure put, you're willing to buy it at that price. So you're willing to buy it at the $23.50. But again, maybe you're not willing to buy it at $20. But if you're willing to buy it at $23.50, you're willing to buy it at $20. It's a no-brainer for you. Again, and in the way to basically the best way, what happens when the stock goes against you, is to always never deploy all your troops at the same time, right? So like, let's say if I have an army, right? I don't set my whole army to attack one nation. You set them strategically here, and there, and then from there, you get what I mean. You don't send all the soldiers, because what happens if they all die? Then you got to get new soldiers. You got to go get, you got to go work more to go get your more capital to then go back to trading again. And that's not what we want. Again, when we're traders, we want to preserve our capital. We are risk managers. That is the most important thing in trading. So when we sell cash secure puts, we want to make sure that we're not sending all our soldiers out to war. We want to make sure that we have some sort of capital in the sidelines ready to pick up where where the other soldiers left off and basically died, if you want to say. But again, if you're selling a cash secure put and then the stock goes against you, always check what sentiment is, check what motive is, and check what management is, and check if the overall thesis of your thesis of the company is still good. And if that is good, then and you think that the price is going to go lower, roll it. But again, don't be careful to roll too early and be careful to roll too late. Those are going to be experiences that you're personally going to have to experience. That's all discretion, honestly, and it's all how much conviction you have on this particular stock. And I can't teach you that in a video. I really can't. I can't teach you discretion. That's something that, again, trading is something that you learn the lessons with money, but then when you learn these lessons from all the times you learn the lessons, when you finally learned it and you finally get everything that you learn from trading, then it pays you back in full. It pays you back because then you'll end up making decisions of these, you end up making decisions that really help you out in the long run. And that's what I would do with cash secure puts. When you sell a cash secure put, you got to make sure that you're willing to buy it at that particular strike price. But again, be patient. See what if this is a nothing burger. If price continues to climb higher, then you could always do that. You could always roll it. You could either roll it for a different strike price or roll it in more time. Honestly, if you really like this particular stock, and you always want to roll for a credit, not for a debit. You always want to roll for a profit, not for you paying out. But sometimes you do have to roll for a debit. And later in videos, I'll explain to you why you have to roll for debits in particular scenarios. And at the end of the day, if you do get assigned with these shares, you wanted them because you really are convicted in this particular stock. Like in the worst case scenario, I own a quality stock at the price I chose. So cover calls that go against you. Now these are tricky. But again, this is a lot better than having the puts go against you because at least you're making money. The worst scenario is that you're making less money than you would have made, but you're still making money. So again, if you're in a cover call and the call goes against you, basically the stock goes past your strike price. So let's say if I have cover calls at a 30% delta, 30 delta right here around these, boom, I have the $26.50, and let's say price goes to my $27 range, $28 range. Again, don't be so weary. And that's why we pick these longer contract days out. You want to pick anywhere from 30 to 45 days out, maybe even a little bit longer from there. And the reason why you want to pick those contracts out is because you got more time to be right, guys. You really do. You want the more time to be right. And that's why I personally like, selling options, is because at the end of the day, I don't have to be right instantly. I have periods of time to be right and theta decay to help me out in being right. Let's see. If this, and also if the stock drops, you collect premium and your cost basis of your stock reduces. So again, when you sell puts, when the stock goes up, you make money. When you sell calls, the stock needs to go down for you to make money, or stay in the middle. But again, when cover calls, when they go against you, basically the stock is moving past your strike price. You have two options. You have basically get rid of your shares is your first option, or you could roll. Either or. If it depends, if you have an exit price in mind, you should when you get into a particular stock, you should have an entry price and you should have an exit price. And if your strike price is close to your exit price, either roll it a couple strike prices for a premium, or roll it out in more time to make sure that, if you wanted to change your thesis for a more long-term goal and a little bit longer, then you could do so. But again, if your cover call is getting challenged, it's a good thing because you're making money, instead of, when you sell a put, and it goes against you, you're actually losing money. So again, this is just it's a double-edged sword, you know? Like at the end of the day, it's again to make money in this particular thing. Not everything's gonna be sunshine and rainbows. There's gonna be some gimmies and gotchas. And this is why the stock selection matters. You got to pick stocks that you're comfortable owning for a couple of maybe years or a particular long period of time. And you don't chase, you don't chase names, just particularly pick stocks that you like and you want to hold for a long period of time. And you don't want to sell options on trash. Your job is to, get your cost basis down and bring some premium through the door. Because again, your job is to make assignment isn't a punishment. It should be part of your plan, and if so, just roll into your right. And to manage your risk, like I said, what keeps me consistent is I size small, I trade liquid stocks, I avoid earnings, I don't max out on margin, and I accept small losses when needed. Risk is decided before the trade, not after the trade. The truth that most people won't say about selling options and about, it being against them is selling options it's not about being right every single time. It's about being right once or twice. You could just continue to roll and roll and roll until you're right. Because at the end of the day, if you're going to hold these stocks, you're going to hold them. If you're going to hold them already, it doesn't matter if it's a couple months from now that these contracts are done. But again, you want to roll them for a particularly good strike price that makes some sort of sense and logical. And that discretion is going to be built over time with selling options and learning those lessons. If this helped you guys understand how to basically manage a risk and understand how if you sell options and how it goes against you, please like and subscribe, and please drop a like and a comment down below. Sammy Trades NQ out.